Good afternoon, everybody. My name is Tony Lajeunesse. I am the president and CEO of TL Financial Group. Thank you so much for attending today's webinar regarding our market overview for the third quarter and market outlook. While there is still some uncertainty regarding our next president, I do want to share with you some fundamentals of the economy and also take a historical perspective of the stock market under different presidents. 80% of you who did take the survey are concerned about this. And so this historical perspective, I hope, should be helpful to you. Today's webinar is in listen-only mode. The presentation is being recorded and will be available on our website and on our Facebook page. So if you have any questions for me, as always, please email me or call the office to set up some time with me. All right, let's go ahead and get started. So here's a summary of some noteworthy items from the third quarter. The global economy rebounded amid the COVID-19 pandemic. There was a lot of government stimulus benefits that the market and the economy helped benefit the economy in the short run. We're going to talk more about that later on in this presentation. Unemployment rate declined from its peak 2020 levels. Equity markets extend their gains achieved into the second quarter. Election fears abound as both sides brace for a potential loss. Even now, as we're still trying to ascertain who is going to be the president, and there are major technology names soar to new highs due to the COVID pandemic. And these are the themes that we're going to be covering today in our outlook, in our economic outlook. We're going to review the stock markets. We're going to go over housing, inflation, employment, and we'll wrap it up with economic activity. So let's start first with the stock markets. This chart, this kind of busy chart, shows the price to earnings multiple, which is the PE ratio for the S&P 500 sectors. Now, the blue dots show the median values and the yellow dots are current readings. PE ratios matter because it helps us inform us if a sector is expensive or if it's less expensive and therefore an attractive asset, which I'll show you in a graph in just a moment. This chart here shows the price to earnings multiples, which is also the part of the PE ratio for various equity asset classes, domestic and international. Now, the disparity in relative valuations can be seen as a sentiment indicator for various markets. Prior to the recent downturn, most asset classes were trading above the median. Note that earnings have fallen quite extensively as of late, so many of the price to earning ratios have moved higher as a result. So the ratio expands because the denominator has collapsed, as is the case in small value. The Shiller PE ratio is defined as a price divided by the average of 10 years of earnings adjusted for inflation. As such, it is principally used to assess likely future returns from equities over timescales of 10 to 20 years. With higher than average CAPE values implying lower than average long-term annual average returns. So the CAPE ratio is a valuation measure that uses real earnings per share over a 10-year period to smooth out fluctuations in corporate profits that occur over different periods of the business cycle. So the CAPE ratio, using the acronym for critically adjusted price to earnings ratio, was popularized by Yale University professor Robert Shiller. It's also known as the Shiller PE ratio. This PE ratio is a valuation metric that measures a stock's price relative to the company's earnings per share. Now, I know that this is pretty wordy and this is a very busy screen, but it's a really important metric to monitor. Currently, the Shiller PE ratio suggests equity returns over the next decade will be higher than the recent periods based on compressed valuations, which have reverted to multi-year lows. Consumer confidence has a high correlation to values, as noted in this chart. Okay, now let's move on to the bond market and interest rates. Now, the Federal Reserve has kept interest rates low with guidance from Chair Jerome Powell, suggesting that inflation will run hot, greater than 2%, before the Fed will consider hiking in this recovery. So the commentary from the Fed suggests short-term rates will be lower for longer, which seems to be putting a lid on long-term rates, which is going to be the next slide, even as the economy begins to improve. Long-term interest rates, as described by the 10-year Treasury yield, have anchored lower. Given the Fed's guidance, investors appear comfortable buying longer-dated fixed income securities to preserve capital and lock in yields higher than those offered by short-term debt instruments like CDs, cash, or Treasury bills. While short-term rates are influenced by the Fed to a large extent, long-term rates reflect future expectations of growth, inflation, and supply demand. With that being said, the Fed has indicated no intention to increase rates anytime soon, which should help keep a bit of an upper bound on long-term rates in the near term as inflation remains stable. If growth picks up and inflationary concerns start to permeate markets, it's likely long-term rates will move higher as investors move away from bonds into riskier assets. Now we're moving on to housing. As mentioned previously, 10-year Treasury rates have continued to move lower as investors buy up Treasury bonds. So the 30-year mortgage rate, which is closely tied to the 10-year Treasury yield, has followed suit. The average 30-year fixed rate mortgage now stands at 3% after nearing 5% in late of 2018. That's a significant number. The result is a more affordable housing market for average home buyers through the stabilization in home prices and historically low financing. Housing prices remain stable in the mid-single digits on a year-over-year basis, while demand has skyrocketed as a result of all-time lows on mortgages. Supply has moved lower as of late, which suggests prices should follow an upward trend in near term, which obviously is a demand and supply issue. And if you're looking to buy a home today, you know that many people are bidding higher than the actual price of the home because there's so much demand right now. What you're seeing here is an explanation of the house price metric. So to forecast the movement of housing prices, we can use the index in blue, which represents one-family homes sold divided by one-family homes for sale. So when the blue metric trends positive, it means that sales, which is demand, are outpacing supply. When it trends negative, it indicates more supply than sales. So essentially, it gauges supply and demand dynamics. Viewing this against the year-over-year change in home prices, a strong correlation between these two indices become apparent. Furthermore, the blue index tends to trend a few months ahead of the housing prices, so it can be used as a leading indicator for prices in the one-family market. All right, let's review inflation now. With interest rates so low, will this cause inflation to get out of control, as some are suggesting? There are many ways to measure the overall level of inflation. However, those above are regarded as some of the most robust. The popular headline inflation number stands at just 1.73%, and the average, which is the red bar, of all measures of inflation comes in at 1.72. So inflation is running below 10-year averages across many measures. The leading inflation index is designed to provide advanced warning of cyclical upswings and downswings in the rate of inflation in the US economy. It is one of the few leading indices designed to anticipate cyclical turning points in the growth rate of the consumer price index. As the economy begins to accelerate, inflation, meaning the price of goods and services, should start to move higher as a result. the current inflationary environment reflects an economy that is on the path to recovery. Core inflation is what many practitioners use as the purest measurement, as it removes the more volatile areas of the headline number, which is food and energy. Similar to the previous slide, core inflation has rebounded as the cost of goods and services has moved higher in the recovery. If this measure moves beyond the 2% level, the possibility of rate hikes from the Fed increases. It's a key gauge in the Fed's monitoring of markets and the economy. All right, let's move on to employment. Okay, traditionally, investors and economists alike tend to look at the total change for non-farm payrolls on a monthly basis to make projections about the direction of the economy. Commonwealth's, which is my broker-dealer, Commonwealth's investment management team has developed the metric shown here, which is a slightly different way of looking at the same data. The diffusion index considers the 3 months change for each industry component of non-farm payrolls, which is financial activities, manufacturing, information, education, and health, and counts the number of positive values and then divides by the number of the industry sectors. So for instance, if 3 of the 10 industry sectors are positive, then the index would return a value of 30%. As is evident from the chart, this metric has done a fairly good job of determining past recessionary periods, which have tended to coincide with a drop below 60% in the index. Now, the severity of the 2020 recession is evidenced by this chart that you can see, where all sectors of the economy shed jobs in the first quarter. The rebound in payrolls has been swift, which is contrary to what many economists had predicted back in March for the latter half of the year. 90% of job sectors increased payrolls over the past 3 months, which is really quite extraordinary and was not expected. The official unemployment rate, the U3, now stands at 7.9%. The U6 unemployment rate offers a broader measure of employment, taking into consideration marginally attached workers and those working part-time for economic reasons. Marginally attached workers are those who have become discouraged and are no longer looking for employment, even though they're willing to work. It's a more holistic view of employment. The U6 measure currently stands at 12.8 after reaching 23 in April. At one point in the second quarter, almost 1 in 4 individuals were without employment. As mentioned previously, the employment fallout was largely contained in the leisure and hospitality sector and did not really permeate into other areas of the economy to a large extent. If businesses begin to open on a larger scale, the unemployment rate should drop significantly and leisure and hospitality roles are quickly reestablished. As the economy improves, this naturally results in increased output and demand for employees. In cyclical downturns, the reverse actually happens. So currently, the ratio suggests that there are roughly 2.5 individuals for every job opening. Now, a consequence of cyclical downturns is a drop in wage growth as employers lay off workers and institute salary freezes to help offset declines in revenue. The abrupt layoff of many lower wage earners has caused a spike in average hourly earnings for those still on payrolls, as higher wage earners haven't been overly affected. As more and more of the lower wage earners return to the workforce, this measure should revert to pre-COVID levels, something that already started to occur in June's release. So, is economic activity rebounding quickly enough to keep it sustained? A proprietary index used by Commonwealth's research team is an item called the Commonwealth Economic Activity Index. It's a broad measure of 4 components of the economy, including the business cycle, consumer, employment, and housing. As seen in this chart, levels below the dark blue line have historically coincided with recessions. The index, in general, tends to do a good job of showing the cyclical nature of the economy over time, with periods between recessions reaching levels near 1 and hovering between 0 and 0.15 during recessions. Now, the index recently moved back into positive territory as of the latest reading, though the economy remains on life support and is really being fueled in part by stimulus programs. There are some glimmers of hope on the economic side of things, as evidenced by the recent moves in ISM services and manufacturing indices, which rebounded in June to pre-recession levels. Services in particular is a noteworthy rebound, as that area makes up a majority of the domestic economy. Levels greater than 50 indicate an increase in activity, while those lower than 50 indicate a decrease. So services make up roughly 80% of the domestic economy. So the services index technically has a larger bearing on things than the manufacturing index. The composite index of 10 leading indicators, similar to the Commonwealth Economic Activity Index, takes into consideration a number of data points, including initial claims, new orders, building permits, and consumer expectations. An increase in the index is generally interpreted as a positive sign for the economy and suggests that the economic climate should remain positive for the next 3 to 6 months. Another proprietary indicator that Commonwealth's investment management team uses to assess economic expansions is the labor index, which is that dark blue line that you see. This metric is designed to track the amount of purchasing power offered by the labor force, and movements higher often coincide with economic expansions, while moves lower indicate contractions. Because consumption is approximately 70% of our gross domestic product, this metric tends to be a really good indicator in forecasting GDP. Current levels suggest a rebound in economic activity, similar to the ISM indices. As mentioned in previous quarters, there aren't any major structural imbalances in the economy to date. Therefore, a rebound could be swifter than what we anticipate. Okay. Now, while we don't know just yet who our next president is going to be, it's important to keep things in perspective as it pertains to the stock market. Under both Democratic and Republican presidents, the stock market has generally performed well with an upward trajectory over the long term. Now, it's important to keep in mind that the myriad of other factors that impact the stock market performance aside from who was elected as president of the United States. For example, the September 11th terrorist attacks and the 2008 Great Financial Crisis occurred under President Bush. President Obama's term, starting in 2009, began when stock market valuations were near the bottom, and as well is well documented now that the stock market went on to its longest bull market in history. The impact of policy here can be debated, but the key takeaway is the limited control any administration has and the impact of unanticipated and uncontrollable events can have for or against the stock market. Therefore, it really is important to make sure you're invested in a manner that is consistent with the amount of risk that you're willing to take. So if you need to adjust your risk profile or you're not sure what your risk profile is, of course, please reach out to me and I'll help you assess your portfolio and provide you some guidance as necessary. And so here are some conclusions to our economic outlook for today. And it's obviously the information is changing quite quickly because Pfizer announced that they may have a vaccine now for COVID, and that has really sparked the stock market here as of late. And if that vaccine is widely deployable quickly, then that can be a game changer for the hospitality and for entertainment venues as well. But let's not confuse politics with investing. While disappointment, as you see these bullet points up here, while disappointment with the election outcome may tempt some investors to turn pessimistic on the markets, it's important to understand the economic fundamentals supporting an improving outlook. Next, recognize the forces behind the recovery. The fundamentals across the employment, manufacturing, retail services, and housing have really exceeded expectations. If not in a COVID-19 environment, the fundamentals would support high optimism under any other circumstances. And then accelerating economic growth leads to increasing corporate earnings. According to FactSet, analysts are expecting earnings growth in 2021 of 23% and revenue growth of 7.9%. A winter COVID shutdown is not imminent. Extreme COVID-related restrictions remain a threat to the economy, but be mindful of balancing the risks. Early wave regions are not under present distress, and hospitalization ratios are down, and more fiscal spending is probably expected. So I would expect another fiscal stimulus package that could increase consumption further into 2021. So what can we expect for the rest of November? The good news is that the solid economic recovery so far is likely to benefit from the good vaccine news that we just recently heard. The results of the election indicate that if it's a Biden presidency, that likely would lead to higher spending. In turn, spending would support economic growth, while any higher taxes or regulations would be constrained by what looks likely to be a Republican-controlled Senate. From a policy perspective, markets see a case for more of the good stuff and less risk of the bad stuff. So that outlook is what may take markets even higher for the rest of the month. Okay, this concludes today's economic webinar. I really hope that you found this information helpful and useful. As always, if you have any questions for me, please feel free to reach out to me. Thanks a lot. Be safe and have a great day.